Well, ARES Capital Corporation is one of the most popular dividend stocks out there, and there's good reason for it. It is one of, if not the largest BDCs out there. It is managed by an exceptional external management team from ARES Management, has a phenomenal long-term track record. It's crushed the broader BDC space, outperformed the S&P 500 handily since it's went public, which really says a lot for a BDC, given that they're income instruments, not necessarily powerful compounding instruments like, say, an Apple or NVIDIA or Meta, which is more of a highly innovative tech company that grows faster. And so it has a lot going for it. On top of that, it pays a very attractive dividend yield that usually varies between 8 and 10%, just depending on the situation and the markets at the time. And it has been remarkably good at, despite paying such a high dividend yield, at not only sustaining but growing its NAV per share over time steadily, and sustaining and even growing its dividend per share over time. And so there's a lot to be said about ARCC. Now in this video, I'm going to share a little bit more about why ARCC is such a good dividend stock, but I'm also going to share about why I think it's getting risky right now, and I think investors need to be aware of those risks and why maybe it's not a good pick for a lot of investors out there right now. Before I get to the rest of the video though, if you like getting regular content on dividend stocks, whether it be individual stocks like ARCC, or if you want to learn more about dividend investing philosophically, you want some sample model portfolios, or if you just want to learn about dividend investing funds, whether they be ETFs or CEFs, please subscribe to my channel. It would mean a lot to me. Thank you very much. Okay, so why else is ARCC such a good dividend stock? Well, in addition to the strengths I just mentioned, they are currently performing quite well. They have a relatively low leverage ratio compared to a lot of their peers. They have a fairly well-covered dividend, sufficient net investment income per share coverage. In addition to that, they have a lot of spillback income, which is excess income that they've stored up over time that they can tap into to support their dividend over time. Because as a BDC, they are exempt from paying corporate income taxes in most cases. But in order to preserve that status, they have to pay out at least 90% of their taxable income as dividends to shareholders. And so sometimes the BDC will deliberately underpay that and not meet that threshold, and in exchange pay a little bit of an excise tax on that extra retained income, or they might pay out special distributions at the end of the year. Now, ARCC has not paid special distributions in a little while, so they've been building up some spillback income. And so they have that there just as a way of saying, hey, if we enter an environment where maybe the Fed cuts rates really aggressively, or maybe the economy goes into depression, we'll have that extra income that can help support our base dividend through that period, because they realize that a lot of investors buy ARCC as an income vehicle. They see that 8 to 10% yield, they see the track record, and they think, okay, I want this stock because it's going to give me a reliable dividend through all sorts of economic environments that I can live on to meet my living expenses. And so they view that as a very almost sacred trust from their shareholders, and they are doing everything they can to meet that through balance sheet strength, through excess spillback income, through maintaining a prudent payout ratio as best they can, through having a large and well-diversified portfolio, through underwriting excellence as evidenced by their relatively low non-accruals. And so that is a huge strength for ARCC, and it's not to be underappreciated, because there are BDCs out there that are a little less prudent in their management of things, and as a result, they've had to cut their dividends over time. And so again, I'm not knocking ARCC's quality. I'm not saying if you're just paying on for the dividend that you need to sell it today. I get it. I get why ARCC is so popular. And in fact, they now trade at a pretty substantial premium to their net asset value, and management can take advantage of that to issue shares that are accretive, help them to further grow their book value and their net investment income per share, and further support the strength of the dividend over time. So again, there's a lot to like there about ARCC. That being said, what's risky about it, and why I personally would not buy it right now? And if I had it, I actually probably would sell it. Before I get into that, if you're liking the video so far, please give it a like. It'd help me to get better distribution of this video, and it would mean a lot to me. Thank you so much. All right, let's dive in to the risks for ARCC. So the biggest risk facing ARCC right now is the fact that it trades at around a 15% premium to net asset value as of this video's creation. And why is that such a big deal? After all, some of its peers like Main Street Capital, Capital Southwest, Hercules Capital, Sixth Street Lending, and others all trade at very high premiums, in fact, higher premiums than ARCC does. Well, here's why it's risky. First of all, historically, they've only traded in line with their net asset value, about 1 times price to NAV or price to book. And so that means that there's significant downside potential if the valuation normalizes, because they have had periods over their history where they've traded at premiums, but almost inevitably it sinks back down to trading in line with NAV. If just that happens alone, that's a major headwind to earnings that's going to offset almost 2 years worth of dividend payments. So I don't know about you, but if you're concerned about total returns, I don't like the odds there, especially because history shows there's not much more upside to the price to NAV multiple here. So the risk reward is not attractive from a price to NAV standpoint. Well, if you're going to have such high NAV, certainly there are other strengths to like about the fund, right? That's justifying that. Well, yes, the track record that I told you about, that is impressive, but management makes the shareholders pay for access to that sort of quality. You pay among the highest fees of any shareholder in the BDC sector when you own ARCC shares. Their fees are very high and not very favorable to investors. And so just keep that in mind as well. On top of that, if you look at ARCC's history, and it's not just ARCC, it's the broader BDC space, but ARCC is no exception. When the market goes into a downturn, especially if it's due to an economic scare, whether it be the COVID crash or something similar, their price to NAV multiple collapses and typically goes well below 1 times. And so we're looking at a very large downside potential in the event of a sudden market panic. Not only that, but that's just the price to NAV. You also have to keep in mind that when the economy takes a hit, ARCC's net asset value per share also tends to take a very severe hit. And so you're going to get a double whammy there. Not only are you trading at a big premium that needs to normalize to 1 times just to be historically average, but it's going to go further down if you go into a market panic. And at the same time, the NAV is going to drop. And so it's not just the price to NAV, but the NAV itself is dropping. And so you're going to see an outsized decline, likely potentially of 40, 50, maybe even higher percent if we get a repeat of what's happened historically. And so that is a huge downside risk. And again, relative to what for ARCC? Well, I don't see much price to NAV multiple expansion in their future. And is NAV expansion in their future? Is dividend growth in their future? Well, perhaps if this premium to NAV can sustain itself over time and interest rates are stable, sure, they should be able to grow NAV, grow net investment income per share just by simply issuing new shares. And they can then increase their income and increase their dividends through it and their NAV. Perhaps. That's fine. And that's been the long-term trend and why it's been such a good investment. But consider these things first. One, Donald Trump is pushing hard for the Fed to cut rates, not just a little bit, but very, very aggressively. And now Jerome Powell so far has resisted those calls, and that's helped prop up BDCs like ARCC because they invest primarily in short-term floating rate loans. And so when short-term interest rates are high, their income rises. When short-term interest rates drop, their income declines. And so it's at an elevated level right now. If Jerome Powell were to cave, or even when his term expires early next year, he's very likely going to be replaced by President Trump with someone who will cut rates aggressively. That's going to hurt ARCC. It's going to threaten its dividend. It's going to probably force it to tap into its spillback income that I mentioned earlier, which in turn is going to start to deplete its net asset value. And when its net asset value starts to decline and its dividend is being supported by stored up income rather than current operating earnings, I think you're going to see the price to NAV multiple shrink. Also, as the NAV is shrinking. So we're going to see some stock price declines. Very unlikely you're going to see dividend growth in such a scenario or any kind of supplemental dividends. And so I don't see much of an attractive total return scenario there. Perhaps the dividend will be sustained, and these things tend to go in cycles. And so things will bottom out. They can, if long-term interest rates decline, they can then refinance debt at lower rates. That helps to offset some of the headwind, or maybe interest rates rise again, or something else happens. And that can help ARCC balance things out. I'm not calling for a dividend cut here. I'm just saying I don't see a path to total return as being very attractive in the near term. And I see significant downside risk on all these fronts. On top of that, if we were to go into an economic downturn, keep in mind that ARCC is one of the more aggressively positioned portfolios. That's part of the reason it's had such good success. It's invested aggressively in higher returning opportunities while still maintaining strong underwriting performance, equaling exceptional returns. But if we have an economic downturn, some of those opportunities could be pressured. A weaker position in the capital stack for ARCC could mean less protection in the event of defaults, and we could see further NAV erosion and potentially a dividend being threatened if things got bad enough. So there you have it. In summary, I'm saying ARCC's dividend, I think, is fine for the foreseeable future. So if you're a retiree who's just investing in it for the dividend, I don't think you have anything really to worry about. However, if you do care about total returns, I think ARCC is not attractive right now. In fact, I would rate it a sell from that perspective, simply because I don't see much more potential than 8 to 10% annualized returns from here as an upside, perhaps best case scenario 11 to 12%. But the downside scenario is very, very deep and in the red if we have NAV declines and price to NAV declines. And even if the bottom doesn't fall out and the market remains somewhat calm, I think we're going to see the price to NAV shrink. We're going to see NAV shrink, especially if President Trump gets his way, which he likely will eventually, either sooner or later, with steep interest rate cuts. So that reason, I personally am steering clear of ARCC right now, even though I do love the underlying company's quality and its long-term story. So there you have it. If you like this video, again, please give it a thumbs up. Check out my channel. You can subscribe to it to get more content like this. I'd be greatly appreciative. Thank you so much. See you next time.